Okay, so who burnt the flopjacks? Seriously, if you've taken a peek at your portfolio lately, especially if you're holding any tech or crypto, you're probably asking that same question. It feels like panic is in the air, but the big picture, the overall market, doesn't seem to be telling the same story. So what is going on? Are we staring down the barrel of an everything crash, or is this something else entirely? All right, let's get into it. Just to give you a sense of the pain that's out there, the source for our explainer today actually shared their own portfolio hit from a single day, a drop of 42.4%. Wow, that's a six-figure loss in 24 hours. I mean, that's not just a number on a screen, that is a real gut punch, and a lot of investors are feeling that exact same thing right now. And believe me, this isn't just one person's bad day. Just look at this. These individual names, especially in tech and crypto, are getting absolutely obliterated. We're talking Figma down over 80% from its highs, HubSpot, Monday, Coinbase, down 60, 70%. The damage is just, it's everywhere, and it is deep. Now, this is where it gets really weird. You've got this incredible disconnect. While all those individual stocks are in a nosedive, the broad market, the S&P 500, is barely down at all, maybe 2% from its highs. It's truly a tale of two markets. It's like we're living in two different financial universes at the same time, which, leads to a pretty unsettling question. You have to ask, right? Is all this carnage, this bleeding in the riskiest parts of the market, is it a tell? Is it the canary in the coal mine warning us that the whole thing is about to come crashing down? Well, to figure that out, we've got to look to the past for some clues. So for section 1, let's play detective. We're going to investigate two of the biggest crashes in modern history to see if there's a pattern, a roadmap for what could be just around the corner. Think back to the dot-com bubble. The high-flying, super risky tech stocks of that era started getting sick long before the whole market caught the flu. You can see it right here on the timeline. Amazon, eBay, they peaked more than a full year before the S&P 500 finally rolled over. The writing was on the wall, but you had to be looking in the right place to see it. And what's wild is we saw the exact same playbook leading up to the 2008 financial crisis. Back then, the riskiest assets were tied up in housing and banks. Homebuilder stocks peaked in the summer of 2005. That's two full years before the S&P hit its peak. The warnings were flashing for a long time. So based on all this, the current situation looks pretty grim, right? Well, not so fast. And this brings us to section 2 and a really fascinating, kind of weird piece of evidence that tells a completely different story. Let's just call it the snowmobile indicator. Yeah, that's right, the company is Polaris. And no, we're not about to start talking about power sports investing. But believe it or not, how this one company's stock is doing can tell us a surprising amount about the real health of the economy, and maybe where we really are in this whole cycle. So, why Polaris? What's the deal? Well, it's pretty simple. They sell stuff you absolutely do not need. They sell fun. ATVs, snowmobiles, side-by-sides. This is the ultimate I'm feeling good and I have way too much cash to burn kind of purchase. That makes their stock an amazing, real-time signal of how the average person is actually feeling about their money. And this timeline just lays it out perfectly. The stock peaked in April 2021, right when all that stimulus money was hitting bank accounts and people felt rich. Then, of course, inflation kicked in, things got uncertain, and the stock took a dive. But, and this is the important part, look at what's happening at the end there. It looks like it's already bottomed out and is starting a new uptrend. And this is the huge twist. If the stock for the most want, not need products out there has already gone through the ringer and is starting to recover, what does that mean? It suggests that maybe, just maybe, we're not in a late stage cycle about to crash. We might actually be in the very early stages of a whole new recovery. It's a completely different way of looking at things. So this really confusing picture is also making the biggest companies in the market do some truly mind-boggling things, especially when it comes to how they spend their cash. All right, quick vocabulary lesson. I promise it'll be painless. We gotta know this term, CAPEX. It stands for capital expenditures. And all it really means is the money a company spends on big physical stuff. Servers, buildings, equipment, all the infrastructure it needs to grow. And right now, the CAPEX numbers we're seeing are just bonkers. Let's just take Google, for example. The source we're looking at puts it perfectly. They're planning to spend on CapEx like a drunken sailor. They're projecting $180 billion in 2026 alone. To give you some context, Wall Street was already expecting a crazy number, around $120 billion. Google basically just blew that estimate out of the water. This isn't just spending anymore. It is an all-out arms race for AI dominance. But a spending spree like that comes with one heck of a hangover. All that shiny new equipment doesn't just go away. It turns into depreciation, which is this massive cost that hits their budget year after year after year. It squeezes their future profits and basically turns these cool, asset-light tech companies into something more like old-school, asset-heavy industrial giants. It totally changes the reason you'd invest in them in the first place.
Okay, so let's recap. We have history screaming crash. We've got a weird snowmobile company whispering recovery. And we've got big tech spending money like there's no tomorrow. What on earth is an investor supposed to do with all of that? Well, that brings us to our final section. What's the action plan?
First things first, a little reminder from history. Every single period of major market fear, every single one in recent memory, has turned out to be a phenomenal buying opportunity. From the absolute bottom in 2009, to the 2020 COVID crash, to the tech wreck in 2022, the moments that felt the absolute scariest were the moments of maximum opportunity. And that leads to the single most important takeaway from all this. This is a direct quote from our source, and it's powerful. Do not let 2026 buying opportunities pass you right by. The discounts, the pain we're seeing in the market right now, these could be the exact setups for massive gains down the line.
It's such a classic psychological trap, isn't it? When things get really tough, people get emotional. They get devastated, they decide the whole game is rigged, and they sell everything, usually right at the bottom. Then they're forced to just watch from the sidelines, full of regret, as the market recovers without them. It's a story that just repeats itself over and over again.
So I'll leave you with this final thought. Right now, the market is a sea of conflicting signals and a ton of fear. And history tells us that this is precisely when fortunes can be made. So the only question left to ask is, while everyone else is panicking, where are you going to find your opportunity?